9,000 rupees per gram. That's 72,000 rupees for 10 grams of gold. If you think that sounds insane, wait until you hear what just happened in China that's about to send shockwaves through the entire global gold market. China, the world's largest gold consumer, has effectively shut down its domestic gold market with emergency regulations that went into effect 48 hours ago, and the panic has already started spreading to India. I'm talking about jewelry shops in Delhi and Mumbai seeing lines of customers trying to buy whatever gold is left before prices explode even higher. I'm talking about the Shanghai Gold Exchange halting certain trading activities and Chinese banks limiting gold purchases to just 50 grams per person per year. This changes everything. When the world's biggest buyer goes dark and India's wedding season is about to kick into high gear, we're looking at a supply crisis that could send gold prices into the stratosphere. If you own gold or you're thinking about buying, the next 20 minutes could be the most important information you hear all year. Let's get into this right now. So let me break down exactly what happened over the last 48 hours, because the mainstream media is completely missing the magnitude of this story. On Monday morning, the People's Bank of China, which is China's central bank, issued an emergency directive to all commercial banks operating in China. The directive implemented immediate restrictions on retail gold purchases, limiting individual citizens to purchasing no more than 50 grams of gold per calendar year through banking channels. But it doesn't stop there. The Shanghai Gold Exchange, which handles over 80% of China's physical gold trading, suspended spot delivery for contracts under 1 kilogram and implemented a 7-day mandatory waiting period for all withdrawal requests above 100 grams. This is unprecedented. China has never, in the modern era of gold trading, implemented restrictions this severe on its domestic gold market. Show chart, Shanghai Gold Exchange trading volume comparison. Now, why would China do this? The official statement from the PBOC talks about maintaining financial stability and preventing speculative excess in commodity markets. But here's what they don't want you to know. China's foreign exchange reserves have been under pressure for the last 18 months as capital outflows accelerate and the yuan weakens against the dollar. When Chinese citizens lose confidence in their currency, they do two things. They try to move money overseas and they buy gold. The Chinese government can control capital outflows through strict currency controls and banking regulations, but gold is harder to control because it's a physical asset that Chinese citizens have culturally trusted for thousands of years. By implementing these restrictions, China is essentially trying to prevent a bank run, not on yuan deposits, but on physical gold. This tells you everything about how serious the economic situation in China has become. The immediate impact on Indian markets has been nothing short of chaotic. Within hours of the Chinese announcement, gold prices in India spiked by 1,100 rupees per 10 grams. Zaveri Bazaar in Mumbai, which is one of the largest gold trading centers in India, saw premiums over London's spot price jump from the usual $15 to $18 to $42 to $48 per ounce. That's a premium of over 250% above normal levels. Jewelers across major cities started receiving panic calls from customers who had booked gold for upcoming weddings, worried that prices would become unaffordable. Some jewelers have stopped taking new orders entirely, while others are demanding full payment up front instead of the usual advance deposit system. When jewelers stop taking orders, you know the market is breaking. 3 to 20. Let me explain why China's actions specifically impact India so dramatically. India and China together account for roughly 55 to 60% of global gold demand. China alone represents 28 to 30%. When Chinese demand gets artificially suppressed through government regulation, that gold doesn't just disappear. It has to go somewhere. And where does it go? It flows to the next largest buyers, which are India, the Middle East, and institutional investors. But here's the problem. The supply of physical gold is relatively fixed in the short term. Mines produce a certain amount each year, recycling flows provide additional supply, but you cannot simply create more gold overnight. When Chinese buying gets pushed underground or redirected through alternative channels, while Indian demand surges because of wedding season and festival season coming up, you get a supply squeeze. And supply squeezes in physical commodity markets always result in explosive price increases. Now let's dig into the data because this is where the story gets absolutely wild. The numbers I'm about to show you explain exactly why we're headed toward 9,000 rupees per gram and possibly beyond. Let's start with COMEX registered gold inventory because this is the foundation of the Western paper gold pricing system. As of the latest report, COMEX registered gold sits at 378,000 ounces. That's 11.7 tons of physical gold available for immediate delivery. Meanwhile, open interest in COMEX gold futures is 523,000 contracts, representing 52.3 million ounces of paper gold claims. Do the math, that's a ratio of 138 to 1. For every physical ounce available, there are 138 paper claims against it, and this ratio has been climbing steadily every single week. Show chart. COMEX registered gold inventory versus open interest ratio over time. But here's what makes the current situation even more explosive. Over the last 45 days, we've seen net withdrawals of 218,000 ounces from COMEX registered vaults. That's 6.8 tons of gold that left the system. Where did it go? Industry sources indicate significant flows to Switzerland for refining and then onward to Asia, particularly to Dubai, Singapore, and Hong Kong, which serve as transshipment hubs for gold entering China and India. Even with China's new restrictions, gold is still flowing into China through unofficial channels, gray market operators, and jewelry imports that are technically allowed under different regulatory frameworks. When a government tries to restrict gold, it doesn't eliminate demand. It just pushes that demand into channels that are harder to track and often more expensive. Let's talk about what's happening with physical premiums globally, because this is the real-time indicator of supply stress in the gold market. In India, as I mentioned, premiums have exploded to $42 to $48 over London spot. In Dubai, premiums are running at $32 to $38. In Singapore, $28 to $35. In Hong Kong, $35 to $42. Compare this to 6 months ago when premiums across Asia were $8 to $12, and you can see the magnitude of the shift. Premiums are the market's way of saying the paper price is wrong and I need to be compensated extra to part with physical metal. When premiums spike across multiple geographic markets simultaneously, it's not a local phenomenon. It's a global supply crisis manifesting in real time. Show chart, physical gold premiums across major Asian markets. Now let me show you what's happening in the refining sector, because this is the bottleneck that's preventing supply from meeting demand. Swiss refineries, which are the heart of global gold refining, are currently operating at 99% capacity and have order backlogs extending into September. PAMP, Valcambi, Argor Heraeus, all the major names are turning away new clients and telling existing clients that delivery timelines have extended from 4 weeks to 10 to 12 weeks. Why does refining matter so much? Because gold comes in many forms. Mining companies produce gold in door bars that need refining. Recycled gold from old jewelry needs refining. Central banks and institutions demand specific bar sizes and purity standards. You cannot simply melt gold in someone's backyard and sell it into professional markets. It needs to meet London Good Delivery Standards or equivalent certifications, and achieving those standards requires specialized refining infrastructure. When that infrastructure is maxed out, the supply chain breaks. Here's what they don't want you to know about central bank activity during this entire crisis. While China is restricting its citizens from buying gold, the People's Bank of China itself has been buying gold for its reserves every single month for the last 18 months straight. According to official disclosures, China's central bank gold reserves have increased from 1,948 tons in late 2022 to 2,316 tons as of the latest report. That's 368 tons of gold purchases in 18 months. But here's the kicker. Industry analysts believe the actual number is significantly higher because China often buys gold through undisclosed channels and only reports the purchases much later. Why would China restrict its citizens while simultaneously buying gold itself? Because the government wants to accumulate strategic gold reserves while preventing capital flight that could destabilize the banking system. It's a brilliant strategy if you're the Chinese government, but it's terrible for Chinese citizens who are watching their savings lose value while being prevented from protecting themselves with gold. 815. Let's examine the Indian market structure, because understanding India's role is crucial to predicting where prices go next. India imports roughly 750 to 850 tons of gold per year, making it the second largest gold consumer globally after China. Indian gold demand is highly seasonal, with peaks during wedding season from October to December and festival season including Diwali and Akshaya Tritiya. We're currently entering the pre-wedding season, where families begin purchasing gold for weddings planned for later in the year. The typical pattern is that prices rise from August through November, then correct in December and January after the wedding season ends. But this year that pattern is being completely disrupted. Prices are already at elevated levels in March, and we haven't even entered the traditional high-demand season yet. If prices are hitting near 9,000 rupees per gram now, where will they be in October when actual wedding season peaks? This is the question that has Indian jewelers terrified. The Indian government's response has been predictably bureaucratic and ineffective. The Finance Ministry issued a statement saying they're monitoring the situation and considering measures to ensure adequate supply. What does that mean in practical terms? Absolutely nothing. The government could reduce import duties on gold, which currently sit at 15%, but that would cost them tax revenue that they don't want to give up. They could release gold from the government's strategic reserves, but those reserves are relatively small and wouldn't make a dent in market demand. The reality is that the Indian government has very limited tools to control gold prices because gold is a global commodity priced in international markets. Indian prices will track international prices plus currency fluctuations and local premiums. And right now all three of those factors are pushing prices higher. Show chart. Indian gold price in rupees with import duty component highlighted. Now let me explain something about the silver market that most people are ignoring but which is equally important. Silver is often called poor man's gold in India, and when gold becomes too expensive, buyers shift to silver as an alternative. We're already seeing this substitution happening. Silver prices in India have jumped from 78,000 rupees per kilogram to 89,000 rupees per kilogram in just the last 2 weeks. Silver jewelry sales have increased 35% according to preliminary industry data. But here's the problem with silver. The silver market is much smaller than the gold market in terms of total value, which means it takes far less money to move silver prices dramatically. If even 5% of frustrated gold buyers shift to silver, you could see silver prices go absolutely parabolic. And that creates a feedback loop where rising silver prices push people back toward gold, which pushes gold prices higher, which pushes people toward silver, and around we go. This is how precious metals bull markets spiral out of control. All right, let's get into the technical analysis and chart work, because while fundamentals tell us why prices are going up, technicals tell us when and how far. On the monthly chart, gold has been in a macro uptrend since bottoming in December 2015 at just over $1,000. We've made a series of higher lows and higher highs over the last 8 years, with the current cycle beginning from the November 2022 low at $1,620. We're now trading around $2,100, which represents a 30% gain from that low. But here's what's significant. We're testing the all-time high resistance zone at $2,140 to $2,185. This is the level where gold topped out in August 2020 during the pandemic panic. If we break through this resistance on a monthly closing basis, there is literally no technical resistance above us. We're in price discovery mode, and the next targets would be purely based on measured moves and psychological levels like 2,500 and 3,000. Show chart, gold monthly chart with all-time high resistance marked. The weekly chart is showing a massive cup and handle pattern that's been forming over the last 2 years. The cup formed from March 2022 through October 2023, and we're now in the handle phase, which is this tight consolidation between 20,000 and 2,150. Cup and handle patterns are continuation patterns that typically resolve with a powerful move in the direction of the prior trend, which in this case is up. The measured move target for a cup and handle is calculated by taking the depth of the cup and adding it to the breakout point. The cup depth was approximately $500 from the high around 2,100 down to the low around 1,600. If we break out from the current handle around 2,150, the measured move target would be $2,650. That would translate to roughly 9,500 rupees per gram in India, which aligns perfectly with the fundamental supply shortage we've been discussing. On the daily time frame, we're in a clear ascending triangle pattern, which is a bullish continuation pattern. An ascending triangle forms when price makes a series of higher lows while repeatedly testing a horizontal resistance level. In our case, the higher lows are at 20,000, 20,030, 20,050, and 20,070 over the last 4 weeks. The horizontal resistance is at 2,130 to 2,150, which we've tested 5 times. Each time we test resistance without breaking down, it gets weaker because sellers at that level get exhausted. We're now on the 6th test of this resistance, and statistically, ascending triangles break out to the upside 82% of the time. When this breaks, I expect a very fast move toward $2,250 to $2,300 in the first leg. Show chart, gold daily with ascending triangle pattern. The 4-hour chart is showing some interesting momentum indicators that suggest the breakout is imminent. The relative strength index on the 4-hour is sitting at 68, which is just below overbought territory at 70. This tells us there's still room to run before we get technically overextended. The MACD on the 4-hour has made a bullish crossover with the MACD line crossing above the signal line, and the histogram is turning green. This is a momentum shift that typically precedes sustained moves. The Bollinger bands on the 4-hour are starting to squeeze, with the bandwidth narrowing to the tightest levels in 6 weeks. Bollinger band squeezes are like a coiled spring. The tighter the squeeze, the more explosive the move when it releases, and the direction is usually in the trend direction, which in our case is up. Show chart. Gold 4-hour with RSI, MACD, and Bollinger bands. Volume analysis is confirming the bullish setup. Over the last 3 weeks, we've seen declining volume during the consolidation, which is exactly what you want in a healthy correction or consolidation within an uptrend. It shows that sellers are not aggressive and buyers are just waiting for the right moment. But in the last 3 trading sessions, we've started to see volume pick up on the green candles and decline on the red candles. This is accumulation behavior. Smart money is building positions ahead of the breakout. When we do get the breakout above 2150, I'll be watching for a volume surge to at least 180 to 200% of the 30-day average. That would confirm institutional participation and make the breakout legitimate rather than a false break that gets faded. Support levels are important to understand for risk management, even in a bullish setup. If this ascending triangle fails, which can happen about 18% of the time statistically, the first support is at 20,070, which is the most recent higher low. Below that, we have major support at 20,000, which is a psychological level and also the 30-day moving average. If we break below 20,000 on a daily closing basis, it would invalidate the bullish ascending triangle pattern and suggest we need more time to consolidate before the next leg up. But given the fundamental supply crisis we've discussed and China's restrictions creating artificial scarcity, I think the probability of a breakdown is less than 10%. The physical market will support prices even if the paper market tries to push lower. So where is gold headed and what are the key levels you need to watch? Let me give you my roadmap for the next 6 months based on everything we've analyzed. In the immediate term, over the next 2 to 3 weeks, I expect gold to break through the 2150 resistance level and make a fast move toward $2,200 to $2,300. The catalyst will be either a continuation of the China supply crisis or a statement from the Federal Reserve that suggests rate cuts are coming sooner than expected or another banking system stress event. Any one of these catalysts will be enough to trigger the breakout. In Indian rupee terms, this would take gold to approximately 8,000 to 8,400 rupees per gram, assuming the rupee stays relatively stable against the dollar around 83 to 84. Show chart. Gold with projected price path and key levels. Medium term, looking at the next 3 to 6 months, my target is $2,500 to $2,700 for gold. This is based on the cup and handle measured move I discussed earlier, combined with the fundamental supply deficit that's developing. Here's why I'm so confident in this target. China's restrictions are not going away anytime soon. When governments implement capital controls and commodity restrictions, they rarely reverse them quickly, because reversing them would be admitting the policy was a mistake. These restrictions will likely stay in place for at least 6 to 12 months. During that time, Chinese demand will find alternative channels, but it will be more expensive and less efficient, which keeps premiums elevated. Meanwhile, Indian demand is going to surge as we enter wedding and festival season. The combination of reduced Chinese official demand being replaced by unofficial demand, plus surging Indian demand, plus already tight COMEX supplies equals a perfect storm for substantially higher prices. The wild card, as always, is the Federal Reserve and U.S. interest rate policy. Gold has an inverse relationship with real interest rates. When real rates, which are nominal rates minus inflation, are negative or low, gold performs well. When real rates are high, gold struggles. Right now, the Fed funds rate is 5.25 to 5.5%, but inflation is running around 3.2%, giving us a real rate of about 2%. That's actually not terrible for gold historically, which tells you how strong the physical demand story is, that gold has performed well despite positive real rates. But if the Fed starts cutting rates, which they've hinted they will do later this year, real rates will compress and gold will get an additional boost. My base case assumes 2 to 3 Fed rate cuts in the second half of this year, taking the Fed funds rate down to 4.5 to 4.75% by December. If inflation stays sticky around 3%, that would bring real rates down to 1.5%, which is a more favorable environment for gold. For Indian investors and buyers, my advice is this. If you need gold for upcoming weddings or events in the next 6 months, buy it now. Yes, you might be able to save 500 or 1,000 rupees per 10 grams if you wait and prices dip temporarily, but you also risk prices running another 2,000 to 3,000 rupees higher and being forced to buy at even worse levels. The risk-reward favors buying sooner rather than later. For investors who are buying gold as a wealth preservation asset, I recommend dollar cost averaging. Buy a portion of your intended allocation now, buy more if prices dip below 20,000, and buy again if we consolidate after the breakout. This strategy removes the emotional pressure of trying to time the perfect entry and ensures you build a position over time. Physical gold is always preferable to paper gold if you can manage the storage and security. Sovereign gold bonds are a decent alternative for Indian investors if you want the price exposure without dealing with physical storage. Look, here's the bottom line. We are living through a historic moment in the gold market. China, the world's largest gold consumer, has effectively shut down its domestic gold market with the most severe restrictions we've seen in modern times. India is experiencing chaos as prices approach 9,000 rupees per gram and jewelers struggle to secure supply. Physical premiums are exploding globally. COMEX inventories are at critically low levels with paper to physical ratios over 130 to 1. Refineries are maxed out and cannot increase capacity fast enough to meet demand. Every single indicator is pointing towards significantly higher gold prices over the next 6 months. This is not speculation. This is supply and demand fundamentals playing out in real time. For those of you who have been sitting on the fence waiting for the perfect moment to buy gold, this is your moment. Not because I'm telling you to buy, but because the market is telling you to buy through premiums, through delivery delays, through government restrictions, through central bank accumulation. When governments start restricting citizen access to gold, that's the biggest buy signal you can get because it tells you the government knows something about the financial system's fragility that they're not telling the public. History has shown us repeatedly that capital controls and commodity restrictions always precede major currency crises. China implemented these restrictions because they're trying to prevent a run on their financial system, but restrictions don't eliminate demand. They just push it into other channels and often accelerate the very crisis they're trying to prevent. So, what do you think is going to happen? Are we headed to 9,000 rupees per gram by wedding season? Could we see 10,000 rupees per gram if this crisis escalates? Drop your price predictions in the comments below. I want to hear where you think gold is going and whether you're buying, holding, or staying on the sidelines. And if you found this analysis valuable, if it helped you understand what's really happening in the gold market right now, do me a huge favor and smash that like button. It helps this video reach more people who need to see this information before it's too late. Subscribe to the channel and hit that notification bell because these markets are moving fast and the next major development could happen tomorrow. When China escalates restrictions, or India implements import quotas, or COMEX declares force majeure on delivery obligations, you want to hear about it immediately, not 3 days later from mainstream media. I'll be here covering every development in real time with the data and analysis you need. Until next time, stay sharp, stay informed, and remember, when chaos hits the markets, gold is your anchor. I'll see you in the next one.